One of the things that we highly recommend is people invest outside of Wall Street. Oftentimes, the person staring at them in the mirror is really their best investment, and actually is their best investment. And then when you're looking for cash flow or other investments, you have to partner with the right people. It's essential. The people are much more important than the fundamentals of any business out there. I came across a website called Pure Street. I read the reviews, I did my due diligence, and I made an investment. And it's something that I've been looking for a long time. And I know a lot of people have been looking for this, and it's the ability to invest in first trust deeds or into the mortgage market where you're actually the bank. But instead of writing a $350,000 loan to somebody on an individual house, you can take a small portion of your capital, say $1,000 or $2,000, and participate with a group of investors. But then again, the people are always going to be the most important behind who are coordinating this, because you obviously have to thoroughly vet these real estate deals. So I have on the phone with us today Brett Crosby. He's the co-founder and CEO of PureStreet.com. Brett, thank you for joining us today.
Thanks so much. Really glad to be here.
Well, Brett, I want to start off with just a basic introduction. First off, what is Pure Street? How do you introduce it to someone who's never heard of the company?
Yeah, it's a great question. In fact, I think you did a very nice overview there and highlighted some of the benefits. But the way I generally describe it is Pure Street's a platform for investing in real estate debt. These are first trust deeds, as you said, always in first position. It's 100% debt focused. We're not doing equity. We're not doing mezzanine, debt / equity or whatever we're doing. It's fairly vanilla and straightforward. These are all short-term bridge loans, generally, typically about a year. And they're generally investments. This asset class, by the way, has been around for a long time. We've just changed the way that you're able to invest in it. And what the asset class is these are short-term loans against real estate. Typically, you have like a real estate entrepreneur who wants to buy a property, goes to a private lender. These are non-bank loans because banks don't really operate in these really short-term loan spaces much. And so they go to a private lender, they get a loan, and that loan is collateralized against the property. And they tend to be short-term, relatively high yield, and we just think it's this wonderful asset. The thing that we've done, and that you pointed out, is we've made it so that investors no longer have to have this very concentrated position in a single investment anymore. So there's this asset, and what we've tried to do is remove some of the negatives of the asset. There's all these positives of it, and we try to keep those while also removing the negatives. And those negatives are where you had to have a very concentrated position. Very few people had access to these types of deals, and if they did, they would be like, in some sort of network, or maybe knew a lender and would be able to participate. But most people, general audiences, weren't able to participate, or they'd be like institutional investors investing in a fund for one of these lenders. And so what we're doing is basically aggregating up the space, curating it, making sure it's very high quality deal flow. And then and we take a more conservative kind of swath of the market because we want to maintain quality. And then we make it so, as you pointed out, you can just diversify. And then we also are making it so instead of a high-touch investment that this investment class used to be, is like, especially to your point, if you want to diligence something very deeply, if you're going to put $100,000 in an individual deal, you want to be very familiar with it. And that's fine for investing in it. But then if it goes bad or something happens along the way where someone's not paying, the borrower's not paying on the loan, that's the other thing that we do is we handle any workout situations. So we've provided access to this. We've made it so you can diversify in a way you could never do before. And we've made it go from a high-touch investment to a very low-touch investment. And so it's just much easier for most people to invest passively this way. So that's
if anybody goes to the website, they click the About Us, they'll see that it's a very large team. If they go to the advisor and investors, they're going to see some familiar names that they've seen either on CNBC or most specifically, if anybody watched the movie The Big Short, they're going to see Dr. Michael Berry. What is the background of yourself and the other founders of this company?
Yeah, it's an interesting group. We have experts across a number of different spaces, and that goes company-wide. As far as the founders, there are three of us. They include myself and my background. I'll try to cover very quickly. I was a co-founder of a company called Urchin. A little after college, we created this company called Urchin. It was very early in the web analytics space. And we helped build that whole industry, the web analytics industry. And then in 2005, we were acquired by Google, and we turned Urchin into Google Analytics, launched that there, and then grew that to by far the largest web analytics platform in the world. I stayed on at Google for just shy of 10 years, and really focused on helping bring to market new products, new ideas, and launch those and grow them. And so I did that on mobile ads, kind of helped make that a space, the whole social initiative at Google, and then Google Drive. And then at the time I left, I was running global growth and consumer marketing for Chrome, Gmail, Docs, and Drive. And we got Chrome to like 1 billion users, number one in the world, number one in the US, et cetera. Gmail recently rounded 1 billion users as well. And I specifically left Google and a great job, and I loved Google. It's a company I still am very passionate about and really like. I left it and moved to co-found Pure Street with Brew Johnson, who's a buddy of mine from college, and we stayed in touch. And his career path was very different than mine. He was a real estate attorney, saw the build-up to 2008 and was very convinced it was going to end badly. He got really obsessed with what was driving it, and it led him to securitization. And he kind of went deep there and saw these flaws in where incentives were just misaligned, where everyone's kind of just taking their piece out and pushing risk onto the next person. And the whole system he thought was basically built on a house of cards and was going to end very badly. So he quit the law because he couldn't advise his clients to do the sort of things they thought were good ideas. And these are huge home builders and stuff like that. And then he ended up, he was going to do a vulture fund. His brother, who had helped start this tech company, was doing very well. And he's like, hey, I need your help. And so he helped him kind of continue to build up this tech company. And then they sold it to Expedia in July of 2008. He stayed on there. But really what Bruce saw in the real estate bubble, and he was like, look, a lot of this stuff just needs to be fixed. And he saw obviously the global capital markets be, brought to their knees, et cetera, and these privatized gains and socialized losses. He just thought the whole thing was really wrong, and felt very passionately about trying to fix it. So what you see inside of Pure Street is actually we've tried to take a lot of those concepts that were wrong and tried to fix them, and also tried to learn from the stuff that worked well and actually continue doing them, like the idea of being able to finance real estate, et cetera. And so that's his background, and he was really the one that came up with the idea. He approached me when I was at Google, and I started as an investor, when it was just a slide deck, and then he's like, you got to do this with me, let's do it. And so I ended up doing that. We brought on Alex Perlman. I'll just be quick on his background. He is basically our CTO and built the entire thing like single-handedly initially, and now we have a engineering and product team of like 20 people or something.
So it's quite a very in-depth team. I think that would make people very comfortable, especially with your background. Now, these loans that people are investing, this debt they're buying, first off, when it says that the loan to value is 75% or lower, just so people understand, that means it's essentially like somebody came in with 25% down, there's equity. How do you know there's that equity there? What is the vetting process to make sure that, if there is a default and there has to be a foreclosure, that it truly is, a deep in the money, asset?
Yeah, that's a good question. Okay, so first off, it's a little bit about how we get our loans that are available for investment on the platform. As I described to my kids, this is a fairly hard concept of a business to understand because there's a lot of kind of heady things that go into it. But if you just think about it, we're a two-sided marketplace. So basically what that means is, this is what I say to my kids. Think about where, there's apple farmers, and there's apple farmers that do red apples, other guys do yellow apples, or whatever, and someone else is doing Granny Smiths. And they want to sell them by the bushel, but consumers want to buy them by the slice. what we do is we go buy them by the bushel, and then we sell them by the slice, so that as a consumer you can get like 2 slices of green, 2 slices of red, and 2 slices of yellow or whatever. And then they kind of get what we're doing. And if you think about that model, that exists all over the place. Marketplaces are a really important part of almost, everywhere in the world. And so we do that in this space, and there hasn't been a true secondary market for private lenders. Banks have a true secondary market. They sell their loans into the GSEs, which are the government sponsored entities of the Fannie and Freddie, et cetera. But private lenders that have popped up where banks really have stopped lending in the real estate space, they don't have a true secondary market. So that's basically what we're providing to them. So what that means is what we do is instead of going after borrowers, we go after lenders and we partner with them and we provide them with capital as well as technology. We've built, and I'll explain why we have this technology quickly, and this will all make sense. So what happens is a borrower goes to a lender in this space in the normal course of their business. The lender decides if they want to give that borrower a loan like they always would, and then they commit their own capital and they make that loan if they decide to move forward. Local lenders have a tremendous advantage in this space because speed is really important. Typically, a borrower needs to move quickly, and if you know the local real estate market, and especially on a street-by-street, house-by-house basis, which most of our local lenders really do, and then you also know that your local borrowers who are doing most of these projects, and often repeat borrowers, which tend to be the best credits because they really know what they're doing in this space, you have a huge advantage. And so instead of trying to disrupt these local lenders, we think partnering with them is a much smarter thing to do because you already have the first level of credit done by them. And then what we do is then we look at each one of those loans and we decide if we want to purchase it on behalf of our investors and make it available as an investment. And to decide that, there's a whole curation process, and we use a bunch of big data. Our first step is we look at the submarket where that deal was done. What does it look like today? We look at the forecast using thousands of data points to look at what are the forecasts looking like over the term of the loan. Then we also, third thing we do is stress test it against the last 20 years and say what was the worst case scenario, and if this repeated that, how would this loan fare? And assuming it passes that, we do a manual underwrite of everything where we have an analyst go through all the details, and we have software that helps them do this and makes it more fairly efficient. And then we have, if that all looks good and we want to proceed, then we will send someone out to physically look at the property. And this is we do this as a service, so it sounds kind of ridiculous, like we're all flying around, but it's not. We send a local person to do the valuation. And that helps set the valuation, look at the comps for this thing, and just make sure that what the lender said, their evaluation roughly matches with ours. And assuming we're good and it still fits within our credit box, then we will buy the loan and then put it up make it available for investment. So that's the whole curation process. And in that whole thing, just to get back to your question, now that I've kind of described how the model works, we are double-checking all of the legal documents and make sure that the borrower actually did put up the money they said they were going to in the deal, we check title on the property and all of those things. So there's a whole purchase history and et cetera. And, it's possible, just to your point, that, fraud does happen in the world. It's possible there's fraud. We actually had one deal where something was fraudulent, and the title insurance company actually stepped up and just paid it off. So in those situations where it's like pure fraud, which those are very hard to catch. Obviously, we look at backgrounds and if people have done crimes or whatever, if they have a criminal history, we're not going to work with them. But if they haven't been caught for that sort of thing, they do that. That's where things like title insurance come in and are very important. And, we make sure that those are in place for all the deals, et cetera.
Brett, who are these borrowers? And I'm interested in knowing how big is this market? Because, first off, I think one question a potential investor can have, why aren't these people going to Wells Fargo and Bank of America? So who are these borrowers? And then how big is this market, this mortgage market that's outside of the big banks?
Yeah, so we think it's a private industry, so it is a bit hard to size, but we believe it's about a $65 billion annual market, and that's just for the 12-month or under fix and flip deals. There are also other types of bridge loans that are for buy to rent. In other words, instead of someone buying and fixing it up and selling it, their plan is to buy it fix it up, and they need a bridge loan to fix it up, and then put a tenant in there and rent it out. And then typically they would go get bank financing once it's quote unquote stabilized and there's a tenant in there, which means there's there's income against the property. So to your question, who are the borrowers and why don't they go to banks? The borrowers typically are real estate entrepreneurs who, and you've seen the TV shows and things like that. These are fix and flippers or buy to rent people, and some are people like you or me who would like to buy a property and fix it up and maybe start getting into building up a stable of properties where you've got tenants in them, but you need a loan to be able to buy it, and the banks typically won't do that loan until it's been stabilized. So traditionally, people would either just buy it with their own capital if they had enough equity capital, or they would go to a private lender to get one of these a bridge loan. So that's who the borrowers are. Why don't they go to the bank? They don't go to banks for these types of deals because banks typically will not lend on a short-term fix and flip because first of all, these are loans that they can't sell to, which is what most banks these days are. They're so heavily regulated, and it's depositor money, so they should be regulated. It's not investor capital, right? It's like your and my bank accounts that they're using to provide these loans. So the banks provide loans, so they typically only want to do like longer term mortgages where you have, and it's based on not the asset but your income and things like that, right? So these are different types of loans. These are done by private lenders. They're non-bank loans. And the other thing is banks just can't move fast enough in this space. Speed is, as I pointed out, is very important to these borrowers because, like you have a property. You're like, hey, I got a deal on this thing. I told the guy I'm going to go all cash and buy this thing in 5 days or, in a week or whatever. I need to be able to actually close, and I need a lender who can close. Banks just don't have that ability to close that quickly. So that's where these private lenders come in, and that's that situation.
Okay, and what's the return that investors are seeing with the PeerStreet.com?
Yeah, so the typical deal ranges between 7 and 12% annualized, and the typical term is our average term has been about 10 months, but you can invest. You can pick and choose your deals. That's, I think, a very important point. Like it's not a pool that you're investing in. You can create your own pool, and that's kind of the system's designed to be able to allow you to do that quickly. But you can pick and choose your deals, and you can go heavy into a deal and put a lot of capital in, or you can go light and just kind of spread it across. I think that's one of the benefits we bring to this asset class we were pointing out earlier. Or you can turn on automated investing, and that's this feature that allows you to basically say, here are the kind of deal parameters I'm looking for. And as those types of investments are available on the platform, we'll match you with those deals. And you say, here's how much I want per deal, like that. And then in my opinion, the cool part about that is that you have 24 hours then to look at that deal, and you can actually back out of it if we've placed you with something you don't like. So the kind of interesting benefit is that you only spend time diligencing deals that you actually know you have a spot in, instead of, it can get, I've personally been frustrated before I was on there and I was like playing around with some and going like, hey, I like this deal. And then when I went to invest in it, it was already filled. And so this way you have 24 hours to look at it and decide if you want to stay in. If you do, great. If not, you can just back out.
What is the legal relationship between the investor and the first lien position? Are they buying into an LLC, or what rights and what is the legal relationship with the investor who put $1,000 into a mortgage security that is backed by a house in Huntington Beach?
What you're actually investing in is a mortgage pass-through security. So it's basically, and the reason, it's probably three things I should probably say about this. Number one, you guys are the one guy, one of the few people in this company who's not an attorney. My co-founder's an attorney. We have a chief compliance officer. Our head of product is a real estate degree. We've got a couple other attorneys in the business as well. So I'm probably not the most highly qualified person to answer this, but here's basically how it works: is that you're investing in a mortgage pass-through security, and that is basically as we get paid along back again for the loan, which is held by PeerStreet. then it's a promissory note to be paid back to the investors, and that's all. It's all spelled out and described in the legal docs on the website, which you can click through as your.
And what's the minimum investment, and then also are they all first liens? So there's no second liens here.
All first position liens. Yep, 100%. That's minimum investment is $1,000.
$1,000. Okay, and then I think it's going to be on everybody's mind. So I need to ask this. Let's say we have another 2008 financial crisis, or let's say the Fed has to raise interest rates to 5% to catch up with inflation or a certain crisis in the currency. How have you guys stress test this model, and are you able to do it where obviously like Texas missed the real estate bubble in the financial crisis, so there wasn't that big of a pullback like Arizona or Southern California. Have you been able to stress test this model in case there was a 2008 financial crisis again or something like it?
Yeah, it's a great question, and obviously no one can predict exactly the future. But what we do know is that real estate is cyclical, and this cycle has been going for a while. So we should be cautious and smart, and so that's part of the reason. That's one of the big reasons, to be honest, we've set up the model the way we have. And let me talk about two scenarios. Let me just say, let's go worst case scenario first. Worst case scenario, we have indeed stress tested the model. We've taken all of our entire existing portfolio of loans, and we've stress tested them against worst case scenarios in each of their submarkets. And to your point, yes, every different submarkets behave very differently in downturns, and some are very affected by, like in '08. Other ones are like .com crash or tied to oil or whatever, right? So looking in the submarkets is very important, not just nationally. And so we have access to that data, and anytime we do a loan, we're looking at that and doing that stress test. But then we've stress tested our entire portfolio and said, what happens in that worst case scenario, and what if it's even worse than '08, and if we had to sell the asset at the very bottom, right? Or say we had to foreclose on it and actually sell it at the bottom. And if we did that portfolio wide, I believe, and obviously you can dial these things up or down or whatever, but we did like what we really thought was a complete Armageddon situation, and it was something like a 2% principal loss of the entire portfolio, which compared to, imagine if you had your money in the stock market versus during that time, or, just about any other place, is a very, very modest reduction in principal. And that assumes like all the worst case things. Now, you don't want to puke the asset out at the bottom of the market. What you would rather do is hold on to it a little bit and fix things. Like if you, but if you assume the entire portfolio was sold off at the same time, that's what it looks like. So pretty, knock on wood, fairly unlikely scenarios, but definitely things you want to be prepared for. The second thing I think I was going to get into is this is why we've set the platform up this way. In a couple of ways. Number one, we take a more conservative swath of the market. So our max loan to value is 75%, but platform-wide, our entire portfolio is 65.1%, I believe is the most recent number. So that means you've got just about a 44.9% equity cushion on top of you, where the odds, like even in '08, you did not see like a 50% reduction within the time of these loans, that these loans burn off. It just didn't happen that fast. You saw a dip, but it was very rare that it would happen that aggressively across, everywhere. And foreclosures weren't at 100%. Our model was, our worst case, we're like, let's say we had to foreclose on everything, which it would be an incredibly unlikely scenario. And then the one other thing I'd say is, in a worst case scenario, and in an everyday practice, having the local lender still sort of engaged in the project is very important. And that's the other reason we set this up this way, because in a major displacement, having all the local lenders who can help us find new borrowers in their network to take over the property, or, these borrowers often have construction crews, et cetera. They know who the local construction crews are to help finish a kitchen or something if we had to foreclose and sell on our property and we wanted to fix it up a little bit or finish something. So having the local guys, again, is very important. And then just in a normal course of business like today, those guys have been, the local lenders have proven extremely useful for us because, we had a situation, for example, where a borrower died and obviously very unfortunate. And that loan was going to get caught up in probate potentially, et cetera. And the lender is like, hey, I'll just buy it because I don't want my track record negatively impacted. And what I'm alluding to there is how we've tried to align incentives where when you invest in one of these investments through Peer Street, you can see exactly who the lender was and you can see their track record. You can see their track record on Peer Street. And our lenders don't want, it typically has been a very opaque industry, and so this level of transparency helps really keep them honest and engaged in wanting their deals to work well, because not only can that track record impact their performance and their investors on Peer Street, but also for their entire business. So, and it's that sort of reputational risk has worked in almost every other place, and it's working well here as well.
That's a really interesting point, because essentially the investors are, sort of unionized with Peer Street in the sense that we're not just the one little guy. We're a big team, and it's a huge group, and that's very, perhaps the number one customer to some of these local lenders when it comes to buying this debt. Okay, so everybody, PeerStreet.com. Brett Crosby, he's the co-founder and CEO. I know this interview is going to have a lot of questions. CEO. Interview is going to have a lot of questions come back. So Brett, hopefully, if we can, maybe we can touch base in about 6 weeks here, because I'm sure our subscribers are going to have a lot of follow-up questions for you.
Great. Absolutely happy to take the questions. And if there's like a forum or something where I can engage, or obviously, you can find us at peerstreet.com and just, reach out. I'm bc@peerstreet.com. You can ask me, or if you have feedback after going through it, our whole team reads feedback at peerstreet.com. So good ways to engage with us.
Thanks very much, Brett, for your time. I appreciate it.
Happy to do it. Thank you very much. Bye-bye.